Good afternoon, Sacha. I'm here with Sacha Sadan, the Director of Environment, Social and Governance within the FCA, so Mr. ESG. And I'm absolutely delighted to have you here, Sacha, not just in light of the theme overall, but also in the light of some very interesting announcements that have come out of the FCA just over a week ago, just under 2 weeks ago, on fund labeling and greenwashing. And I would love to hear a bit more about them, but also in the context of the theme of our overall conference, which is kind of forward-looking data and how we make forward-looking data credible. So we can see how that fits into the package or how the package reflects this. With that, maybe, Sacha, starting, do you want to set out a little bit what the FCA announced and how it fits into this theme of forward-looking information?
Hi, everyone. Well, and thank you very much for having this opportunity. So I've been in the investment industry for a very long time, and the one thing I do know is that there's not one silver bullet or magic bullet that's going to solve everything. But this announcement on our sustainability disclosure regime and our labelling regime as well is one part of that, and I want to talk about that. But as you said, there's quite a big area of growth in this, and we're seeing it. But what we're seeing is lots of different parts. So the FCA has a role to play, but has a role in the international stage, but also working very closely both with the EU, but also on an international stage. So on that, if we just go to the announcement that we made, we've been talking about for over a year and had many, many consultations. We had over 240 responses to our SDR disclosure and labelling regime. And it took us a bit longer than we thought it would because we had to really make sure that this is going to work. The first thing that made this an easier job is we'd like to thank the EU for the SFDR and going first. Now, we know first mover is not always, sometimes you have an advantage, first mover, and sometimes you have a first mover disadvantage. But you learn from that. And obviously the industry has helped us by telling us some of the good things and the things that could be improved from the SFDR regime. And so we have made sure that we've come up with 4 labels, and we can talk about them in detail if we want to. And the new one that came up from our consultation to our final policy statement is the mixed goals, sustainability mixed goals. Because what we found when we talked to the industry was that there were many, many investments that have multi-asset or in different products, but all wanted sustainability, but they're not all in one specific pot. So we've still got impact, we've still got focus, and we've got the one that we really feel quite excited about, the improver label, which is something that we learned from SFDR and other regimes, that there was too much of an exclusionary approach rather than trying to change parts of the system that we need to if we're going to solve problems that we really are facing. So that's a starting point. And there's a huge amount of anti-greenwashing rules for the entire industry as well, with 7 examples of where greenwashing would be occurring. So we're trying to help the industry with guardrails.
And actually, looking at the proposals, I think in scope they apply to, well, it'd be interesting to talk who they apply to, because obviously the fund management industry, but maybe you can unpack that because it goes beyond UCITS and alternative funds, if I look at it correctly. And also, much of the world seems to be very retail investor focused, but I don't think it applies specifically to retail investors alone. Maybe me say a few words around that.
Well, to start with, we've absolutely put the consumer at the heart of this. So this is certainly rules for consumer products, not so much for institutional products, but we're already seeing quite a lot of discussions with some of our pension funds and everyone else. And we've done 15,000 consumer tests to try and get these rules in place. So this will be for fund managers who are selling products in the retail space to consumers. Of course, there is going to be, for a period of time, some technical abilities of overseas fund regime, which is run by our HM Treasury, and there will be discussions about how that will fit in. But for asset managers who are selling products in the UK, with UK-based domicile, these rules will apply. We've estimated that it's over 630 funds that this will apply to in the sustainability area. And we estimate that at least 45% of them will want to have these labels or will be able to strive for those labels. If you don't have these labels, there will be two things. If you're an overseas fund, you'll be having to say to the UK on a platform, we do not have a label, we cannot have one for now until we converge and some of the things that we're going to talk about. And secondly, if you don't want to use the word sustainability, you don't want to use sustainable, you don't want to use impact, but you want to use one of the sort of softer ESG words like responsible, you're going to have to say that you haven't got a label and why. Explain why you haven't got a label, even though you're using one of those words like net zero, Paris aligned, responsible. So we're going to make it quite clear in the first page of a document that a consumer will be able to understand someone that's trying a positive sustainability outcome and someone that just has a perhaps very fair, gentle, I take responsible investment in my investment approach, but I'm not targeting some sustainability positivity.
Thank you. And you mentioned already the mixed category, which I find indeed very interesting and innovative compared to the SFDR regime in Europe. But also, as you say, the improver category, yes, which in a way is kind of a transition fund.
Correct.
And how does that work? And coming to the theme of today's discussions overall that we're having, how do you expect fund managers to take into account forward-looking expectations? How do we ensure that fund managers don't oversell and overact their expectations and therefore fall under the danger of greenwashing, but that they also, on the other hand, don't become too conservative or inaccurate in how they articulate the sustainability and social impact of their fund management?
So that's the crux of it. That is absolutely the crux of the question. This is a growing market. ESG, sustainability, the fund market is growing exponentially. People are very excited about it. People want to do some stuff, but there hasn't been any guardrails in place. And so some people are saying, I've excluded something, or I'm integrating ESG into my investment process, but I'm not actually targeting forward-looking metrics, as you quite rightly say, and yet they're selling these as sustainable. And I think we have to put that balance. So what we're doing, and when we talk to the consumers and the stuff, it has to have a outcomes-based. You have to be thinking of something. So it might be, I have companies that are not perfect, but I'm going to make them less imperfect with metrics, and those metrics will then have to be forward-looking. It would also be impact. It might be people saying, I'm only going to invest in things that have positive impact. And I think it is really important that we get the difference between responsible investing and real sustainability positive outcomes. So yes, you're going to have to think, but if you're going to sell a fund to a consumer that says it's Paris aligned, you have to think of the future, because it's not going to be aligned for the past, and therefore you're going to have to explain what the metrics that you think are. And of course, some of those metrics are being defined and are in place at the moment. So part of our work, not just at the FCA, but at IOSCO, International Securities Regulator, is how can we think about future? And there's a couple of things that go into that. So I think I might just quickly, if you don't mind, briefly bring them up.
Very interesting. Thanks, Sacha. Yes.
Two examples. One, obviously we have the International Sustainability Standards Board, which has come out with its first two standards, as well as from the EU with EFRAG, which are thinking about forward-looking metrics. Secondly, with that, you're also seeing the Net Zero Data Unit, which is trying to think of data utilities, trying to think of how we can do this sort of thing in advance. So that came from President Macron and Bloomberg, and that's trying to give data that's out there free of charge so people can start looking. And then thirdly, we've been really excited. In the UK, we've set up the Transition Plan Task Force, which is already published at COP28, how people should be doing transition plans. And of course, the transition plans is about the future. Now, we would expect that that data from all of those initiatives will be incorporated if you wanted to get a sustainability label. But what we've not done is said, be too prescriptive, because it's far too early. We want innovation and we want the market to evolve, and therefore we are giving the tools and the labelling, but we're letting the fund managers explain to the consumers which one of those tools they are using.
Very interesting. But before I come back to transition planning, and I know you've been active because you've been an active member of that task force, and we spoke in that capacity before. One thing that's also, I think, quite innovative about the package of proposals is what a fund manager has to do should they realize that their forward-looking expectations are not met, their objectives are not met if the path diverges. Maybe you can say some words around that, because it doesn't mean that you immediately lose your label, but it says something about risk management and the communication around that you as a fund manager have to do.
Yeah, I mean, let me start from my own simplistic 25-year career as an investor. There are many times that you invest in companies, whether it's bonds, equities, where you say, my aim is that I think this company is going to produce, 15% earnings growth. Well, life doesn't always work like that, and things change. And the answer to an investor is, what do you do when the facts change? And you have to have an investment process. And sustainability should be the same. If I plan that I'm buying a company that's going to reduce its carbon emissions, or a company is going to put 30% women on its board, but then it doesn't do it, what are you going to do? Now, what we've said in the labels is exactly the same as we would expect. You must explain to the investor what the process and the escalation and engagement. So 2 things would be obvious. The company hasn't done what it said, so we may vote against it. Stewardship is really, we may vote against at the fund level, the label level, but we may also, because we care about diversity or net zero in the entire asset manager, we may vote against that company in all of the funds that we own. Explain that in the first 2 pages of a consumer document, how that would work. Or give an example. The retail investors really do like to see an example. We voted against X oil and gas company because it hasn't hit its carbon emission targets. The third point is, of course, you may say exit. We may exit that company because we don't believe it is going to hit those forward-looking sustainability outcomes that we were expecting.
I find this fascinating, Sacha, because...
And it's really important. I think it's really important that we don't be too prescriptive. I find it really important that people are using exclusionary techniques, but sometimes screening in. But also some of the point is we will stay and we will use our voting. And I do find that stewardship is not talked about enough when I talk on the European stage. I always talk about corporate disclosures, but about influence and managing is just as important.
It's interesting because that was the one little footnote I had to the UK package, because it said where the EU started looking at stewardship, maybe enough is somewhere in the paper. And I'm not sure. I think you're right. In reality, on paper, I'm not sure, because we had separate delegated acts on fiduciary duty that look at ESG requirements as amend MiFID and amend the different pieces. How it's been implemented, I don't know. But I agree, there's certainly more area of improvement. One thing before we maybe move to the transition point that I find interesting is, well, if you're a fund manager, you've got a portfolio, to meet your label, it doesn't mean that 100% of your investments need to be required. So there's always been this kind of slightly cynical fear that you have 10% the most polluters in the world. But as long as you've got 90% happy, clean companies, it's a clean label. So how do you balance that tension, not about meeting the clean objectives, but that in the non-aligned piece, you don't run counter to the objectives of the underlying label?
Well, look, I've been in the industry for a very long time, and the one thing I do know, it's not easy to have everything pure. Pure is nice to say sometimes, but even when you're looking at, let's think of an impact fund that is raising assets to then invest in a new, maybe solar plants, wind turbines, tidal, student housing. It doesn't all have to be climate.
Yeah.
Sometimes you have to raise the cash first before you can invest it. And sometimes you'll have cash on the balance sheet. Cash isn't a bad thing if it's going into that. So you have to think about that sort of liquidity arguments as well. So let's think about in the real world of real funds that are out there. Secondly, we wanted and we have put in the labels that if you are having anything in, so we've put a 70% number out there on the focus fund, how much it needs to be in there. But if the other 30%, it would have to explain if there's anything in there that is pursuing an objective that is completely opposite. So we will make sure that it's clear for a consumer. So it's not just 70% and do what you want with the other 30%, but we are being pragmatic. But if there is anything in that 30% that isn't going in the aims that you're doing, you need to explain that in a consumer-facing disclosure that they could understand. That's how we've put that there.
Yeah, and I think that makes sense because there are also, as you say, underlying prudential requirements that still apply as to the risk diversification between bonds and equities and other forms of investment.
Absolutely.
Liquidity management. So that still needs to be met.
And one last thing, I mean, a really interesting thing. The day you find out that a company isn't hitting the target that you thought it was, do you need to use your fiduciary management skills of when you exit that or when you vote against, rather than you only have a very, very short period of time to balance it? So you've got to make sure that you can play the most important part. You are trying to make returns for clients as well. You have to balance that. And as long as you're balancing that with a little bit of flexibility and you're moving in that direction, and we will be able to spot that in our supervisory techniques, that's really important.
Like,
We want this to work on every level, both for the fund managers, but also for the consumers that own this.
I think that's a really important point, Sacha, because the moment it becomes very quantitative and is perceived too quantitative, those judgment elements get lost and you could potentially have cliff effects. So that's very encouraging. I want to come to one other point. You mentioned work you're doing on transition plans feed into this assessment of the fund managers. I guess it's through the transition plans of the individual corporates into which the fund managers invest, or do you expect the fund managers to have their own transition plans? How does this work together? What's the dynamic here?
Well, if you think about it, let's go take a very short step backwards. It wasn't long ago that the most important thing, and it was in the EU and the UK, was TCFD plans. Yeah. And TCFD plans here in the UK, we said to the largest listed firms with our listing rules at the FCA, we expect you to publish TCFD plans. But we then also said we expected large asset managers to produce their their TCFD plans. Well, that will be the same with transition plans going forward, which are based on the same 4 pillars of TCFD. This is not, I live in the real world. This is not, yet another box ticking. This is using what you've already learned from TCFD, but going a little bit further. And of course, TCFD is now rolled into the ISSB. And guess what? The metrics that we are thinking that may be used by fund managers to prove to the investors what they are aiming for should have an FRAG standard or an ISSB assured metric. So we are trying to use the tools in the toolkit that are already there rather than brand new things. And when we speak to corporates, and they were involved in the transition plan task force, it was corporate CFOs who were involved in it. They were saying, these are the metrics that we would think if we were trying to find a 2050 target with 2030 and 2040 sort of interim stages that would help us know whether we're achieving it. So we're trying hard to bring that, but we're not being prescriptive. The labels can be very different things for now until we get these plans out there. But the most important thing is when we were at COP, most people were trying to think about how can we get consistent transition plans across the globe.
I mean, one of the things, though, finishing on the package that I find interesting, there is, of course, the implicit stake underlying all of this, in that you say, as a supervisor, this is linked to the advertisement laws, this is to the requirements and the greenwashing for misrepresentation, acting in the best interest of the customer, as you make very clear that this is built into the FCA rulebook. So there I think you go nearly a bit further than the EU, at least it would appear, when it comes to the enforcement of the rules and under the potential of non-compliance. Again, that would be interesting to see how non-compliance and doing the best effort in a market fit together. I don't know what your thoughts are on that potential tension.
Well, the first answer is we've got to start somewhere. Even the industry said to us, we want some guardrails. It was getting a bit difficult out there with all these different words, all these different phrases, people doing different things. So we've done that. And we have had, I've been really, my team have been really pleased with the responses we've had, both from consumer groups, but fund managers and also, the industry. So I think it is quite important. But secondly, you can't put guardrails without having a stick. That's the whole point. But two things I think are really important. The first one is you can absolutely not want a label. You do not have to have a label. You just cannot use certain words if you're going to use a label, and you're going to have to put some restrictions if you are going to use other words. But that will at least explain to a consumer what is going on. And thirdly, it isn't just the FCA. Whenever you're looking at any of these ecosystems, we have the Advertising Standards Authority in the UK, which again has been doing some great work. So we've tied in our anti-greenwashing rules to be very consistent with what they're doing. Now, I think that makes it more powerful, because if you follow the new rules, you're involved with all the regulators. But then the other way around, if you fall foul of those rules, you've got both the Financial Conduct Authority and the Advertising Standards Agency to be worried about.
Thank you. Maybe one very last question, moving to ESG ratings, because I know you've been involved in that. And we've got a fairly prescriptive piece of legislation on the statute books here in Europe at the moment. Maybe explain the approach you've taken, which is quite different because you're going down a voluntary route, and also how you expect the ESG framework contributes to, let's say, reliable, forward-looking information.
Okay, so again, when we started this conversation, there is not one size fits all. So the first thing, universal standards that are assured by auditors so that we can trust the numbers that are out there from corporates. Labelling, so a consumer can trust that this product is trying to find an outcome. But ESG ratings are a really important part of the investment process. People are using ratings. Now, first thing, as we know, we very much help the IOSCO principles on ESG ratings. So there is an international code of principles. So we are following that. So is Hong Kong, so is Singapore, so is Japan. So this is not just UK. We have decided, first of all, that we wanted to help the industry with a voluntary code of conduct, which Japan and we've seen Hong Kong just recently announced. We are speaking to our own legislation about whether ESG ratings comes into our perimeter and get regulated in the future. But for now, let's try and fix some of the problems. And some of those problems are things that we've seen in credit ratings and other things. Conflicts of interest, transparency, methodology, all the things that you and I talk about, which are pretty well known. And if we can solve them not just at a UK, but at an international level, that helps investors everywhere. Secondly, one of the points is very important. You come up with a code of conduct. One of the things that I would like to know, I mean, this is just me, but we've seen it in other areas like Singapore, how much of your ESG rating is looking backwards and how much is looking forward. Now, that's why we are not stopping the market, but if the market is clear and transparent, then people can start using forward-looking versus backward-looking. But part of that, we need better data. So having the transition plans coming through will give everyone that opportunity, and the net zero data public utility will also give more forward-looking metrics that could be used in the future. But I think it's really important because the first question I would like to know is how much of the rating is on E, how much is on S and how much is G, and how much is forward-looking and how much is backward-looking. So the more we can get that out into the market with transparency, the better for everyone.
Super. Thank you so much, Sacha. It was an absolute pleasure speaking to you, as always. And thanks for giving us such a good insight into the UK's thinking around these important issues. And we look forward to continuing that discussion and seeing how the UK framework is evolving. Just to give you that sense, yes, we see a lot of interest in the framework that you've just announced, and also by other jurisdictions, as you said, who are looking at this as an alternative to the SFDR. They're not that fundamentally different, but in the edges and the approach pragmatism, they are slightly different. Let's put it like that.
And first of all, thank you so much for letting me have this opportunity. But we are working so closely with our friends in Brussels. We've put a mapping on the back of our labelling to Article 6, 8 and 9. We've very much looking at the new review of SFDR. We're working very closely to try and help both sides, and we're learning from both sides. So thank you very much.
Yes, actually, that's a really good example of good rulemaking. Those annexes are incredibly helpful. Thank you very much to your team, Sacha, for making those available.
Pleasure, absolute pleasure.
Thanks very much.